Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. Investors took out about $3.3 billion from the conventional fund business for the week ended September 28th, 2016. Now, initially, they cheered, obviously, the Fed leaving rates unchanged, and then continued on into this week as well. But they also appreciated hearing that the weekly jobless claims numbers remained lower than had been expected. And so really we started the week off on a good foot. However, there was some discouraging news throughout the week that they had to contend with. First of all, Deutsche Bank was, just railed over the idea that they had to pay about $14 billion in fines to the United States government, and they were basically saying they weren't doing it. And what brought this issue up is the Angela Merkel, the Chancellor of Germany, said she wasn't going to bail this group out, and a lot of people were thinking Deutsche Bank was too big to fail. So there was some concerns around that, and also we saw this vacillating opinion on what the OPEC would do with the oil prices. At first they were on again, off again. Saudi Arabia came out many times and said, hey, this is just consultative. We're not going to do anything with oil prices. We're not going to be able to fix the number of output. But then it turned out on on Wednesday that they did come to an agreement about actually being able to work together in trying to fix the amount of output. It doesn't mean it's a done deal, but it certainly elated the market at the very end. So we did have some good numbers at the end, but really the week was kind of a ho-hum week, and I had a lot of ups and downs in there. Let's see how these news items actually impacted flows into the mutual fund arena. In our macro group objectives, equity funds lost about $6.3 billion, so they were, investors were quite dour on the situation. But taxable bond funds took in about $2.4 billion, and muni bond funds continued on their merry way for 52 consecutive weeks now, inflows of about $600 million. And money market funds saw about $50 million in inflows. That was about it. But there really is quite a story. I'll get to that later on. Well, that brings us to our kind of individual breakouts, and I'm going to talk about equity funds first, and this will be for equity mutual funds, and later I'll discuss a little bit about the equity ETFs. They had about a 0.52% return, so as I told you, the market actually finished the week, ended Wednesday, up about 0.52%. It's the second consecutive week we've seen positive returns, but we continue to see outflows. 29th consecutive week we've seen outflows, this time to the tune of $6.3 billion, and how it broke out is domestic equity funds took it on the chin, $5.4 billion in outflows. 34th consecutive week they've suffered outflows, but ironically they had good returns of 0.56%. Non-domestic equity funds actually lost money for the 13th week in 14, and they lost about $900 million out of there, and they had positive returns about 0.5% as well. So really it was one of those weeks we had good returns, but investors were dour on equities, and they were afraid of what's going to happen, especially with upcoming elections going on. How it broke out, we had large cap funds that actually saw the biggest outflows, $4.8 billion, and global income funds also saw outflows about $600 million. Well, that brings us to the equity ETFs, and this was a tale of two cities. First of all, we saw the first week in 3 of positive inflows. We had $7 billion net new money come into the coffers of equity ETFs. At the top of the list was SPDR SP 500. SPY saw about $3.9 billion in net new money come into their coffers, and the iShares Russell 2000 basically saw about $800 million come into their coffers as well. Now at the bottom of the barrel, we saw Deutsche X Trackers. This was the equity hedged EFA, saw about $1.1 billion in outflows, and then the iShares MSCI EFA also saw outflows, about $0.5 billion in outflows. So really a tale of two cities. The ETF investors basically were pro on equity funds, while the retail investor was definitely negative on equity funds. That brings us down to something that they actually had in common, and that is fixed income, investing into fixed income securities. For the second week in a row, we've basically seen inflows, $2.4 billion this week, and for the second consecutive week, we saw plus side returns as well for fixed income funds, about 0.42%. At the top of the group, we saw corporate investment grade debt funds taking $1.3 billion. It's the 4th consecutive week they've seen inflows, and now flexible portfolio funds actually took in about $500 million. It's the first week in 6 they've seen net new money come into their group. While at the bottom of the barrel, we had corporate high yield quality, basically the highest level you can get into, at the bottom of the barrel, but they only lost about $14 million. Well, that brings us to the ETF side of the fixed income universe. We saw $2.3 billion net new money come into that group, and it was the second consecutive week they've taken in money. iShares iBox High Yield Corp, putting risk on here, $898 million net new money coming into that group. And Spider, Barclay High Yield Bond Fund, saw about $528 million as far as new money coming into that group. At the bottom of the barrel, we saw iShares 20 plus Treasury Bond Fund lose about $678 million. And again, as investors were taking some risk off, basically we saw treasuries at the bottom of the barrel, and we saw higher risk assets at the top. So it was kind of a unique week for that. This brings us to Muni Bond Funds. Muni Bond Funds saw for the 52nd consecutive week inflows, this time to the tune of $610 million. It's the first week in 4 they've had positive returns, only 0.21%. And National Munis, actually, as it has been doing for the last 52 weeks, took in the largest chunk of money over their single state brethren, about $523 million of money coming into that group. Well, that brings us to the money market story. And the money market funds have been very fickle over the last several weeks. And this is the type of breakout that we're going to show you. For the first week in 5, we actually had positive inflows to the tune of $50 million. That is almost a rounding error in the numbers that we're looking at. Taxable money market funds took in about $6 billion. And how that broke out, institutional investors put about $9.7 billion back in, while retail investors took about $3.7 billion as withdrawals. But one of the trends we've been seeing for quite some time is tax-exempt money market funds getting it on the chin, losing about $6 billion. So here's what the story kind of adds up to. Over the last several months, we have been watching the trend of the money market rules impacting flows into certain classifications. So institutional money market funds year to date have seen an outflows of $486 billion. That's a huge amount of money. However, on the flip side, institutional U.S. government money market funds took in $387 billion. So investors, because of the new rules coming up with the floating NAV versus the fixed NAV, are preferring to put money into something that has a fixed NAV. Institutional government money market funds are one of those funds, and that's been happening. On the flip side, if we take a look at tax-exempt money market funds, they have been taking it on the chin. There still is an institutional exemption, or institutional mandate there. If institutions are investing into the muni money market funds, they will have to go to a floating NAV. So a lot of people have been pulling money out of that, and that's where we've seen most of the redemptions. They've had redemptions to the tune of $107 billion so far this year. But we can go back to the concept that muni bond funds have taken in about $45 or so billion year-to-date numbers. So not all of the outflows out of the tax-exempt money market funds can be attributed to the new money market rule, but in fact, a combination of the new money market rule and also interest into the muni bond fund. Well, if you'd like to do a deeper dive and take a look at some sectors that I might have left off, you can visit our site at www.lipperusfundflows.com, or you can join us next week when one of our analysts will talk to you about the flows of the week. I'd like to thank you for joining me, and I'd like to wish you the best in your wealth planning and creation. My name's Tom Roseen. Thanks for joining me.